Walmart is a favorite consumer staple stocks for many people and has been a decent investment for the last few years. But there is a much less known European company that I think is an even better investment. Ahold Delhaize. In fact, I am already invested in them and have just increased my position further. And please excuse me in advance if I butcher the name throughout the whole video. It really doesn't go easy from my German tongue. As of this recording, Ahold has a Seeking Alpha Quant rating of 4.9 out of 5 points, and they are ranked as the number 1 in the consumer staples sector out of almost 200 companies, and also the number 1 in food retail. Honestly, these ratings are a bit of a lucky coincidence, because I had planned this video for a couple of weeks already to align it with the yearly report. And I have just noticed these insane ratings when I started my detailed preparation for the video. So today I will go over the business of Ahold, look at the latest financials and compare them directly to Walmart to explain why I think they are a better investment. My name is Florian, thank you for joining me today. Over the last 12 months, Ahold has outperformed the S&P 500 with 27% total returns versus 8.3% of the S&P. And they could also easily double the performance of the Euro Stoxx 600 index, where they are included, over the last year. But over a 10-year period, the S&P could still outperform Ahold with 213% total returns versus 161 of AD. This is not bad at all for a boring old consumer staple stock. And now is also a good time to look at them with the general market volatility going up and some money rotating out of US stocks into European ones and out of tech into more defensive stocks. But as Peter Lynch said, behind every stock is a company. And to determine if a company is a good investment, we first need to understand their business model and what makes them special. Ahold Delhaize is one of the world's largest food retail groups, headquartered in the Netherlands. They were formed in 2016 through the merger of Royal Ahold and the Delhaize Group and are operating throughout Europe and the US with different local brands like Albert Heijn, Food Lion, Giant or Hannaford. As consumer staples, the company provides a wide range of products for everyday needs. This includes all kinds of food, from high-quality daily products to low-cost frozen items and even pet food. But they also offer general merchandise such as electronics, newspaper, tobacco, gasoline, beauty care and even pharmacy products. So while you may not have heard of Ahold Delhaize, the chances are that if you live in an area where they are operating, you know at least one of their brands. Between all these different shop brands, they generate 60% of their sales in the US and 40% in Europe. The majority of these shops are still in Europe, where they operated more than double the shop count than in the US. But their strategy is the same for both regions. In this strategy, they have 4 focus areas that will deliver long-term growth, namely innovating for growth, leveraging their size and lowering the cost base, further invest in the customer value proposition, which is all about delivering trusted and high-quality products at affordable prices over all channels, offline as well as online, and densifying and growing their markets, which means on one side to optimize their portfolio to grow the customer reach, and on the other side to expand to additional territories. Yeah, I know this sounds a bit general, but especially their investments in customer value proposition as well as technical innovation were the main reasons why the company caught my eyes in the first place. And it was not on paper, but actually in real life with their Dutch brand Albert Heijn that at the time I first got to experience them in Amsterdam more than 15 years ago, they already had the kind of shopping experience and use of technology that I'm missing in some German shops even today. One very recent example for this is that they are using machine learning to generate a 50-day demand forecast for every product in every store. That is more than 1 billion predictions per day. And with these predictions, they can ensure that the shelves are properly stocked while the food isn't wasted. Regarding densifying and growing their markets, right at the beginning of the year, they announced the acquisition of the Romanian brand Profi, which will double their footprint in the country and help them to speed up their growth in the Eastern European region. What I also find very interesting is their focus on their own brand sales. These play a critical role in the strategy of the company because they are tailored to each market, often sourced from local suppliers, and still offer a great value. Right now, these own brands make up around 1/3 of the food sales in the US and roughly half in Europe. Until 2028, the company wants to increase this to 45% on a global basis. What I have not mentioned yet, but is actually key to their customer value proposition, is that they run an omnichannel approach for all their brands, which they see as a major competitive advantage. With this, they are bringing together their online services with their real-life shops. Their vast network of stores, as well as their cooperation with delivery services like DoorDash, helps them to cope with the rising demand for same-day deliveries, in contrast to a strategy with fulfillment centers that are rather used for next-day deliveries. This has helped them to steadily increase not only their sales in general, but also the online portion of their sales. The US portion of this did unfortunately decline a bit last year, but this was mainly due to a divestment of Fresh Direct that had a negative impact of almost 7%. So, in my opinion, we have a very strong and, for a consumer staples, a very innovative company here. But the same could be said for Walmart. And in the intro, I already said that I think that Ahold will be the better long-term investment than Walmart. Let me explain why I think that. The first point are the gross profit margins and the operating expenses as percentage of their sales. And as you can see in the orange lines in these two graphs here, Ahold's gross profit is 26.6% of their sales, while their operating expenses make up 24%. In the case of Walmart, the gross profit margin as percentage of sales, which they call here the gross profit rate, on a global level is lower with only 21.6% internationally and 26.8% in the US. But the operating expenses as percent of the sales are also a bit lower with 18.4% internationally and 22.1% in the US. But Walmart's profit in absolute numbers is also almost double the profit of AD. So it is easier for them to find synergy effects and keep these expenses relative to the sales lower. But this size is exactly why I think that AD has an advantage here. As we just saw, their relative profit margins are already higher, and as the smaller company of the two, it is much easier for them to grow, especially because their growth strategy also heavily includes acquisitions. So Ahold has the much higher potential than Walmart to further lower their expenses and increase their margins, in my opinion. The strategic position of both of them is pretty similar. They are both working in a highly competitive and price-driven market. Due to its sheer scale, Walmart has an advantage when it comes to the pricing power to their suppliers, but as a grocery supplier, Ahold doesn't face that big of a threat of being replaced with other brands than Walmart, who faces a broader range of substitutes beyond groceries. So overall, I would say that they both have a similar moat and a similar strategic position, even though their strengths and weaknesses are a bit different. So next, let's have a look at Ahold's financials and let's also see how they compare to Walmart's. The revenue and EBITDA are growing steadily and we can see some jumps every time there was an acquisition. The net income and EPS also point up steadily, even though we can see some fluctuation here. But this is normal for consumer staples and we will see the same trend for Walmart's numbers. As investor, the most important metric for me is the free cash flow, and same as the revenue and EBITDA, it also shows a regular and steady uptrend for AD. And for the very attentive amongst you, the last data point here says 2024, but the data is from December 2024, so it is indeed the latest one. For Walmart, it's a bit different. The revenue and EBITDA are also going up smoothly and steadily, while the net income and the EPS are a bit volatile. But what looks much worse for Walmart than for Ahold is the free cash flow. This is also pretty choppy for Walmart, and the trend from the recent years is rather pointing downwards. Overall, we have a 5-year annual revenue growth for Ahold with 6.2% compared to Walmart's 5.4%. The free cash flow trend couldn't be more different between the two companies though. While AD could grow their numbers by 5.6% per year in the last 5 years, it did decline for Walmart by minus 18.5% annually. So here we really have a very significant difference. But at least the EPS growth for Walmart was higher than Ahold's. The reason for this reduction in cash flow for Walmart is a steep increase in their capex spending, mostly related to investments in e-commerce platforms and supply chain enhancements to compete with other e-commerce platforms. But we can also see that the operating cash flow in case of Walmart, here the red bars, has quite a high volatility and doesn't show a clear uptrend. I like the picture that Ahold paints here a lot more. Here we can see a very nice uptrend in operating cash flow, and their capex spending has even been going down despite all the store restructurings and improvements that they are also doing. This has led to an insane free cash flow yield for Ahold of almost 9% that compares to Walmart's 1.5%. The EBITDA margin of Ahold is also a bit higher with 6.5% compared to Walmart's 6.2%. But the return of invested capital of Walmart with 13.8% easily beats Ahold's with only 5.8%. Both companies have very decent balance sheets with reasonable debt to EBITDA ratios, but Walmart beats Ahold here with the ratio of 1.2 compared to Ahold's 2.2. Both of them are below my threshold of 3 times though. Where Ahold handily beats Walmart again is with the share buybacks. While both companies are buying back shares, in the last 5 years Ahold did it 4 times faster with a yearly share dilution of minus 4.1%. And they just announced another share buyback program of shares worth of €1 billion, which is exactly the same high level as last year. And I find the numbers for Ahold especially impressive as they are also acquiring new brands on a regular level. To do this, while at the same time buying back shares on such a high level, while also keeping the debt levels reasonably low, is not a small feat. This again shows the power of their high cash flow, which enables them to do this. And both companies are not only returning value via share buybacks. Both are also paying dividends. Walmart with a yield of 1.1% and Ahold with a yield of 3.4%. And the yield from Walmart is already after a 20% crash in stock price, while Ahold stock kept quite stable. And despite the higher yield, Ahold could also grow the dividends 3 times as fast as Walmart, while also keeping the cash flow payout ratio at only half the value of Walmart. And because the growth from AD came with a much higher yield, the effect for investors was leagues ahead of Walmart. If we would have invested in Ahold 10 years ago, your personal yield or the yield on cost would be at 6.3% today. In contrast to this, if you would have invested in Walmart 10 years ago, your yield would only be at 3%, still lower than Ahold's today. So, for dividend investors who are looking for a passive income and are not planning to sell the stock, Ahold would have been the better investment even though Walmart had the better total returns. Again, this shows the power of a high cash flow. But the dividend growth from Walmart might also become higher in the next years. Because in their last quarterly report, they announced a dividend increase of 13%. I still think that it will be hard for them to outgrow the dividend of Ahold because their payout ratio is already double the size of them, but still. So up to now, we have seen that Ahold has by far the superior free cash flow, could grow their revenue slightly faster than Walmart, is by far the better investment for dividend investors, and in general has a much higher focus on returning cash to their investors. On the other hand, Walmart has the higher EPS growth, has the lower cost ratio and has quite an incredible return of invested capital. And their debt level is also a bit lower. But what is the expectation for the next years? The 36 analysts that cover Walmart are very bullish for the company and see an average one-year upside of 30% despite or maybe even because of the recent dip. I think that there is a good chance that this will be adjusted to the downside in the next months though. I find this price target very optimistic and I will explain why in just a minute. But first, let's also have a look at Ahold's forecast. Here, the one-year outlook based on 16 analysts isn't so optimistic, with an average one-year upside of just 3.8% above the current stock price. And we can see why when we look at the growth forecast. The expectation for Ahold until 2028 is that they can grow their EPS by 6.8% annually and their revenue by 2.5%. In terms of revenue, this is lower than what they had in the last 5 years, but their EPS growth is almost double the one they had. Walmart's EPS should grow even quicker with 10.3% annually also until 2028 and their revenue by 4.4%. In the case of the revenue, that is 1% lower than what we had over the last years, but in terms of EPS, it is also a bit more. These forecasts are also roughly in line with what the companies themselves expect for their next fiscal years. So while the growth expectation for Walmart is a bit the one for Ahold, the reason why I think that the price target is optimistic is the current valuation. This is, depending on the metric, 2 to almost 4 times higher than that of Ahold. Walmart has a PE ratio of 32, an EV to EBITDA of 16.4 and price to cash flow of almost 19. Even the PEG ratio is at 3.7. This valuation is closer to high-growth big techs than to other consumer staples. If we take Nvidia as a comparison, for example, their PE and PEG ratio are even lower than Walmart's. And Nvidia's valuation comes with growth rates of over 100% per year in terms of revenue growth. So, in my opinion, Walmart is vastly overvalued, especially for a consumer staple stocks, even if their growth is on the upper end for that industry. Ahold, on the other hand, is even quite a bit below the sector medians. Now, Ahold is a Dutch company, and European companies in general are usually quite a bit cheaper than their US counterparts. So I would not expect Ahold to catch up with these high valuations. In fact, when we compare Ahold to its own 5-year history, we find that their current valuation is already rather on the upper end of their range here. So I would not assume that the valuation will get much higher than this. But despite Walmart's crash in stock price, their valuation is also still way ahead of the 5-year averages. Before I sum this up and come to my conclusion, if you find this video interesting and maybe even learned something that you didn't know before, please hit the like button and subscribe to the channel so you don't miss out on my next analysis. It also helps me out a lot and doesn't cost you a thing, so thank you very much. All in all, I like Ahold a lot better. For once, even though Walmart is also operating internationally, the vast majority of the business still comes from the US. And while this is also the biggest market for Ahold, they are much more globally diversified. Their dividend yield and dividend growth is also much higher than Walmart's, and despite this, their payout ratio is even lower. So, for dividend investors especially, it is hardly a question which of the two is the better option. I have talked about the valuation in length, and while I don't think that Ahold is particularly cheap, Walmart is priced insanely high, and as we saw, in some cases even higher than Nvidia, which doesn't fit at all with their growth rates that are admittedly a bit higher than Ahold's. But what I like most about Ahold is that they are a real cash flow machine, which they also pay out to their shareholders with their dividends and share buybacks. But this is just my opinion, and I'm also already invested in Ahold, which makes me a bit biased. So, which of the two companies do you like better? I'd be really interested to hear your thoughts down in the comments below. And guys, I am trying to be fully transparent about my investments and my investment strategy here on this channel. That is also why I share and update my portfolio on a regular basis. If this sounds interesting to you, be sure to check out the latest update right here. And this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.